Good evening, everybody, and welcome to Serene Education. Thank you so much for joining us on this evening's webinar. We're going to have a little bit of fun again this evening. I always believe that that is the right way to learn. Before I just move on, I'd have put it on the screen here. For those of you who are new to Serene Education, please ensure that you have customer services at sereneeducation.com in your contact list. We do have a problem with our contact provider not liking Yahoo and Gmail accounts, and some of them do go into your junk folder. And to follow us on facebook.com/Serene Education, we put a lot of updates and information on there. I am just going to ask if you could read through this disclosure. By continuing with this presentation, you are agreeing to the terms and conditions within. Right, I'm starting off by saying that how happy I am this evening. You know, sometimes I get online and I think, well, I wonder how many people are actually going to join us on the evening. And a lot of the time, it's all of the people who, particularly on our FX pros, that join in the webinars, and I absolutely reward that, because the more webinars that you can get onto, the more you hear about Forex, the better you're going to become at it. So I reward those people who keep on coming back and learning more and enjoying the presentations along with us. But this evening we have probably about 75% of new people that have joined us. So I welcome you to Serene Education, and I introduce you to myself, Nikki, and my husband, Chris. Chris came to the UK from South Africa in 1999, and I came across in 2001. Chris was working in the courier industry. He was cycling around London, delivering passports and credit cards, and I was working in the hotel industry, working very silly hours. From the hotel industry, I moved to a company that was teaching people how to trade the stock market, and I moved there as an events manager. Now, they didn't pay you anything more than your salary. That was it. Your bonuses and your pension and everything else that you would expect, they said that they were giving you the gift of learning how to trade. Now, when I first moved there, I thought, there's no ways. I'm not interested in trading. I can't do it. I'm not clever enough. There's absolutely no way. So, you know, I may as well just be happy with the salary that I'm getting. I then progressed up to general manager of the company, and I realized that the whole system was based around just really getting people's money. It's called bums on seats. So I decided to go and get education elsewhere. I started to learn how to trade the stock market, and Chris followed on shortly after me. The problem is when you're working really long hours, to try and find the right company in the right sector and all of that, it's really, really difficult. And I almost gave up until I found Forex, and I've never looked back since then. Chris saw how much less time I was putting into my analysis, into my trading, and I was making more money. So he followed on suit after me, and both of us have never looked back since then. So I'm glad that you've all given yourself the opportunity to either learn how to trade or think about giving yourself the chance to learn. Tonight's webinar is all about a little bit of fun. I believe that if you can have fun whilst learning, you interpret it a lot better and you learn a lot more. So my question is, do you know how to drive a car? Now, 99% of people know how to drive a car. Maybe not so much in the UK in comparison to South Africa, because we've got the public transport, but majority of the people do know how to drive a car. Now, what I want to do is show you that the principles that you learned when you were learning how to drive are pretty much the same as if you're learning how to trade. So if you can keep your trading approach as simple as your driving approach, you're already halfway there. So this webinar is titled Your Road Rules to Help You Avoid Your Own Trading Tragedy. And the first one is learn the rules of the road. Now, you had to learn to drive the right way, didn't you, when you started? And you would take driving lessons to learn the correct principles of driving that car. These lessons are taken by people who know how to drive. You wouldn't learn to drive from somebody who had no clue themselves, would you? These people have a qualification in order to be able to teach you. There are rules that you have to learn in order to be able to pass your test, and you do that by practicing. You go for your lessons, they teach you something, and you go away and you practice. And that is what's going to help you progress as a driver. You then pass your test, you get your license, and you now are qualified to drive. There's no difference to trading. You take lessons on how to trade the financial markets. Now, those lessons are taken by people who have the skill and the experience. You wouldn't go to somebody who has no clue about the financial markets and ask them to teach you all about it. You're going to put that training into practice on a practice or what we call a demo account, and then from there onwards you move on to a live account. When we're consistent, we become comfortable behind the wheel. In other words, comfortable behind your computer, and that is what's going to give you confidence. Now, confidence is one of the major keys in order of becoming a profitable trader. The thing is that you're going to be surrounded by so many people who are going to say, trading is risky. It's a risky business, you're crazy to try it, and you're going to lose all your capital. The thing is, they are 100% right. And I think maybe a couple of you have fallen off your chair, the fact that I've said that. But they are extremely right, unless you learn the rules of the road and apply them correctly on a daily basis each time you get behind the wheel or each time you get behind the computer. Trading is a game of probability. If you stick to the rules of the road, the rules of the trade, you are going to have more probability on your side, and that probability is what is going to make you those profits. Now, learning the rules of the road mean that you need to apply technical tools. The first one is support and resistance. Now, we covered this in last week's webinar. Now, support and resistance are levels on the chart at which price changes direction. The higher level is always known as a resistance and the lower level known as support. If you didn't get on the last webinar, then you'll have an opportunity at the end to let us know, and we will send this across to you so you can get more information regarding the support and resistance levels. You're then going to add things like indicators, moving averages, RSI and MACD. Now, these help us determine whether there's momentum behind the market movements. Now, we don't want to be trading something that is going sideways. We want something that is moving. And indicators like that are going to give us an idea of market movement, i.e. how fast the car is driving. On top of this, we're also going to need to understand things like spreads, lots and commissions. These are things, terms used when trading the Forex market, the amounts of money that you would need to pay your broker in order to place the trade, money management to make sure that you don't wipe out your capital, risk management, trade management, how to devise your own trading plan, how to devise your own strategy, and what brokers to use and what platforms to learn. And these are some of the things that we are going to go through this evening. Your steps to learning. Well, your first step is to learn the rules of the road. Learn the rules of the trade. You get a good grounding on the subject, then you progress your skills and your knowledge and you learn more and you advance further. The whole thing is about taking tiny steps each day at a time. You learn from your mistakes so that you don't make them again, and you profit from your winners to grow your capital. And the thing is, risk is lack of education. Reward is financial growth. Road rule number 2, check the conditions before you're setting off. Now, if you're planning on going on a journey and there are flood warnings, hurricanes, torrential snow, black ice, traffic delays, whatever it might be that is on your journey, you are going to be cautious about getting in that car to drive, wouldn't you? Again, trading is very similar. We have things what we call news announcements, and these are the conditions around which we make our decisions whether we are going to trade or not. And things like interest rates, unemployment, inflation, a country's GDP, they all factor into whether we are going to get into that trade and go ahead with it. Now, there's a place that we go in order to check for these weather announcements or news announcements, and this is Daily FX. There they have an economic calendar that is going to show you the news that is out on a particular day, the currency that it is coming out on, what the news announcement is, and then you'll see whether it says low, medium or high. Now, low impact news is not really newsworthy. It doesn't mean that the markets won't move. They're just not expecting the markets to move that much. Medium impact, you need to take caution, and high impact news, extreme caution. The rule to trading a news announcement, well, don't drive in bad weather and don't trade around medium to high impact news announcements. And rule number 2, just don't break the first rule. This is an example of the Swiss franc this last month. We saw a 1,900 pip drop in one day over a news announcement. Now, as you can see, price was trading up really nicely. It wiped out a lot of people. It wiped out a lot of big traders. It wiped out a lot of institutions, and it wiped out a lot of Forex funds. So it's important to make sure that you don't trade around bad weather. Road rule number 3, pick a route and stick to it. When you don't stick to the route when you're driving, well, number 1, you could get lost and never make it to your destination and give up and turn back, or you could add hours of driving time to your journey trying to find your way back to your route. When you don't stick to the chosen route when trading, well, you can lose your way in your learning process and you can throw in the towel before you even start. And this is a big problem with a lot of people, is that they veer off the path. They don't stick to their route. They don't stick to their trading plan and agenda and strategy. And because it doesn't work straight away, they throw in the towel. Or you could take years to become a consistent and profitable trader. You can stay on the right route by determining your trading plan. Now, this is your approach to systemize your trading style and your trading routine. Now, a simple way to look at this is to put it into what, when, how, and why. Now, what would become, what currency pairs are you wanting to trade? You know, it might be 1 or 2, it might be 10, it might be 15, you know, it might just be the 4 majors. And what are you prepared to risk in any particular trade? Now, this boils down to money management, which we'll get to at one of the sections. When, this is determined by your time constraints, your when you're working, when you've got free time, as in when you're going to be trading. How? These become your rules, your step-by-step rules, and this is what we teach you in all of our training programs, is a systemized approach to looking at the markets, the rules that you need to follow, the road rules that you need to follow in order to make sure that you've done thorough analysis. Therefore, it's giving you more confidence. And why? This is a big thing in your trading. You need to have a big enough reason why you're trading. It's not about money. Of course, we're trading to make money, but what's that money going to do for you? And make sure that you read that every morning. When you don't stick to your trading plan, you could end up in trades that you would not usually be in, change the rules to fit the trade, forget about an important news, and risk more than you can afford to. So stick to your trading plan. Now we have one of our FX professionals, our year-long students, online with us tonight, and he's probably falling off his chair and hiding underneath his table right now because we just received an email from him. He has been on FX Pros, our year-long training program, for 2 months. He had never had one losing trade until today. The plan went out the window and so did the trade. And that is the thing. If you don't stick to your route, you don't stick to your plan, you know what you should be doing, you know where you should be going, a slight veer from that route can be potentially dangerous in your trading. Road rule number 4, know how far you can afford to go. Unfortunately, our cars do not run off fresh air. Cars take money, some more than others, to fill with fuel in order to get to our destination. The further the destination, the more fuel is required. So we can only drive our car if we can afford to get it from point A to point B. Trading accounts require fuel or money in order to be able to trade. Now, some brokers are going to allow you to open up a trading account for around $50 to $100, but the more that you have in your account, the more choice you will have with your trades, and ultimately the higher the profits you'll be able to achieve, and the further you'll be able to drive. We need to understand risk and money management. Now, never trade with money that you cannot afford to lose. That puts a lot of pressure on you as an individual in order to try and make a profit from that initial startup capital. You should only risk a certain percentage of your trading accounts at any one trade, and don't double your risk to try and make up for a previous loss. Now, this is just a simple example that we bring into our training. If, for example, you are betting $1 per pip. So a pip is the lowest denomination, so 1 cent. So for every cent that the market moves, you are going to bet £1. Now your stop loss, which is a safety net, which we're going to get to, is going to be 30 pips away. Now, if you're only prepared to risk 1% of your trading capital, you need to have £3,000 in your account. If you're willing to risk 5%, you need 600. If you're willing to risk 10%, 300. Now, this is just a breakdown to show you, to give you an idea of how much money you would need in your trading account, depending on how much risk you are willing to carry in each particular trade. But rule number 5, know where to stop along the way. Now, welcome breaks are there for a reason. Driving for long periods of time without a break is dangerous, not only for you as a driver, but for other people on the road. So by stopping off and taking a break and stretching your legs, it allows you to continue the journey with more focus on the road and of others around you. So these breaks are for safety. So when you're trading, we have what we call safety nets or safety measures as well. These are called stop losses. Now, stop losses are designed to limit your risk. They are there as safety nets, so if your position goes against you, if, for example, you're buying and the currency turns against you and starts to fall, that is a safety net so that you do not lose your entire trading capital. So let's go back and remember our money management that we just did. First, we need to determine how much we are willing to risk in a trade based off that initial investment. So if we say that we can only risk $30 or £30 in any one trade and the risk is higher, you just cannot take the trade. You need to move on and look for something else that is available. That stop loss has to be in a relevant position, something that we are going to teach you on the training, to make sure that you get it in the right place so you limit your risk and you know exactly how much you could potentially lose if that trade turns against you. So the stop loss rules: don't ever trade without a stop loss. And rule number 2, don't ever break rule 1 again. Rule number 6, avoid road rage. Well, I tried so hard to find a woman behind the wheel, because I promise you that's one of my things. I do get road rage when I drive into a city. I'm trying to control it, but it is just one of those things, and it's one of those things that you need to learn as a trader as well. So the meaning of road rage is aggressive or angry behavior of a driver of a car. Now, angry people make silly decisions, don't they? And it blinds you from the skills that you have as a driver, and your focus is based on anger rather than clarity. Rage trading kills as well. Angry people make silly decisions, ones that give you losing trades. If you have trade rage, what I call, it doesn't benefit you. It only benefits a person making money from you, i.e. the broker. You lose all clarity of the chart when you experience trade rage, which is not going to give you a healthy outcome. Revenge trading is never sweet. Revenge trading is what I call when you enter into a trade and you lose. Then you start to double up your risk in the trade to try and make it back, and you lose that. That becomes what we call revenge trading. It's based off anger. You're angry because you've lost and you need to make that money back plus more. Stick to your trading plan. Right, rule number 7, know what type of driver you are. I love this part. The first one is the chilled out one. Now, they stick to the slow lane. They've got a relaxed personality. They're not in a hurry to do anything. They take their time in making decisions. Now, these are what we call the passive trader. They are the longer term trader, which will mainly trade off 4-hourly, daily, weekly, and monthly charts. Again, we covered this in one of our webinars, what type of personality would best suit you. The next one is the fighter. Now, they still stick to the road rules, but they're a go-getter, they're sharp-minded, they're quick-thinking. They don't like to be dilly-dallying. And that's what we call an aggressive trader. Now, they short-term, they look at the shorter-term time frame, the hourly, 30 minutes, 15 minutes, around that time. And then the next one is the speed demon. Well, they don't stick to the rules of the road. they like to gamble. They drive fast and take risks. They're daring and they'll take chances whenever they shouldn't. Now these are called a risky trader. Most of these risky traders are generally scalpers, but they can fall under any time frame. So what you need to do is determine your personality. But what I recommend is you try your hardest to adapt your personality to a passive trader. Try the markets on the bigger time frames, get comfortable and confident doing that, and then over time, if your time constraints allow you to, then you start to move towards a more aggressive type of trader, but never become a risky one. Road rule number 8, practice. Well, the more that you drive, the more confident you become behind the wheel. That's a bit obvious, isn't it? I'm not saying that we should be driving, putting on lipsticks and talking on the phone at the same time, but you get the idea of what I'm trying to say here. But the more comfortable you are behind the wheel, the more you're able to do, and you're still able to drive safely. So the more that you trade, the more confident you're going to become as a trader as well. So by practicing your rules and applying them consistently, you are going to become more confident. You're going to start to see the results. You're going to see how these rules of the road are falling into place, and you're starting to see the results. And you're going to be able to analyze the markets quicker and act and react accordingly and analyze more trading pairs. Confidence comes with education, patience, practice, perseverance, a strong, calm mindset, and sticking to your trading plans. Road rule number 9, remember, slow and steady. You can't learn to drive in an hour. Some people might be able to, but most people take between 10 to 15 lessons to learn how to drive properly, the correct way, and these lessons again are done with a qualified tutor on a one-to-one basis. We knew when we got into a car for the first time that it was going to be a process. It was going to be a learning curve for us. We would go for our lesson, we would learn something, and we would come away and we would practice it. It was going to be a process. And it takes time to build a strong foundation in Forex as well. You need to understand that this is not something that you can master overnight. I'm not going to tell you that, like probably many of the other organizations out there are going to. It is not a get-rich-quick scheme. The only way to do that is to win the lottery. It's going to take you time to have a sound knowledge, get the skills and the confidence to master your and drive your platform. But once you have those skills, do you know what? The thing is, you have them for life, and you have the best business in the world. A strong Forex foundation equals consistency, and consistency is the key to success. You're wanting to make consistent profits. You don't want to go and make £1,000 and then lose £2,000 in the next trade. You've got to become consistent. This is one of our students, Demi. I think he might be online with us tonight, just using him as an example. He has made consistent pips over the last 3 months after being on the FX Pros year-long training. And it's that consistency that builds a confidence. And you can see by the way he's analyzing the markets and the way that he is looking at them that he's starting to get more and more confidence in those trades. We've asked Demi and Michael, actually, that we brought up early, to join us on next week's webinar. So make sure that you join in with us, because you are going to learn a lot from their experiences that they've had so far. Road rule number 10. Take the route that will get to your destination the quickest. There's going to be a fork in the road at some stage when you are driving. So, which path do you take? Well, there's a road that you can choose that will lead you to potential failure. What I mean by, I don't want to say failure, because it might not mean failure. I would say potential failure, or the road to success. The difference here is that the failure is because there's been lack of action. The success, because you've taken action. The failure, because of lack of education, and the success, because of education. Saminda, who's also online with us tonight, he has made this last month in January, he set a target for himself for January, and he nearly tripled it over the course of that month. And those are fantastic. He made the decision to get educated. He took action, and he's getting more than the results that he has been looking for. Now, I've spent thousands in education. Blood, sweat, and tears, to name the least. I've traded, I've gambled, I've made money, I've wiped out my accounts, I think 3 times in total. And I promise you, I've learned every lesson that there is in the book. But was it worth it? Well, absolutely. I would not be where I am today if I had taken a different path. You know, I sit back and I think, you know, what if I had taken that other path? Where would I be right now? I'd probably still be down in London working 12, 15 hours a day, 7 days a week. I wouldn't have the freedom of time, which is life. And I wouldn't be able to spend every moment of my time with my child, which is priceless. So absolutely. It's about getting to that fork in your life and deciding which path is going to be the best one for you to take. Now, last week's statement, I showed that I've made £8,550.36 profit in 3 weeks. Well, I decided to stop there. Then we were online with our FX pros in the support room that they have, and I got a little bit of a challenge. Make your monthly target 10K. The problem with me is I am always up for a challenge. So it was challenge accepted. In about 30 minutes to an hour, I'd sent through, I had made it. Got in my account £10,171.25. That was me definitely done. The problem is everybody has their downfalls. You know, I am not afraid to show people my losing trades. I have done so in many webinars previous to this because I believe that honesty is the best policy, and not to blindfold people into thinking that things are what they aren't. And my biggest downfall that I have is called overtrading. You know, when you get to a point that, say you set yourself a target of £5,000, or you set yourself a target of £500, and you make £500 for the month, but you're only the first week into that month, you got already what you wanted. So if you take another trade, you run the risk of losing what you wanted already, and then having to start all over again. And that's one of my biggest problems. It always has been, is that I get to a stage and think, well, you know what? I can make a little bit more. But the problem is one losing trade would have brought me back under that 10,000 that they had set out for me. I had already reached my own personal target, which was fine, but I wanted to ensure that I had made my target for my FX pros. But as I say, it's my downfall. I overtrade. So what happened? I'll let you know at the end. So once you've mastered the roads, the paths become serene. Now, let's just do a little bit of a wrap up here. The first thing that you need to do is learn the rules of the road, get educated or get left behind. Check the conditions before setting out. Always look to see if there's any important news announcements that are due out. Pick a route and stick to it. Determine your trading plan and stick to it. Know how far you can afford to go. Practice safe money management. Know where to stop along the way. Always use a stop loss or your safety net. Avoid road rage. Focus on the charts and don't let your emotions take over. Know what type of driver you are. Then apply the correct principles to your trading. Practice. Use a demo account to become consistent and then move up onto a live account. Remember, slow and steady. Take your time and make the right decisions because key is consistency. Take the route that will get you there the faster. Action in education. But I wanted to add one extra thing to our road rules, and that is, when in doubt, use a sat-nav. Now, if you had a sat-nav, you would use it, right? All you do is you plug in the destination, And what does it do for you? Well, it gives you confidence behind the wheel that you are going to know where you're going. It gives you a direct journey to take. It gives you heads up before you have to take a turn. And it tells you when you need to take a break. It even tells you where the traffic cameras are. So, with every training that you get with Serene Education, you get your own personal sat-nav as well. It might be the Forex Made Easy strategy. It might be the FX Ultimate 4 strategy, or the FX Ultimate 8, all of which Chris is going to show you later on in the presentation. Anybody can do this. This is a picture taken when my son was 3 years old. We were teaching and we were down in the training room, and he got out of bed and he came downstairs and he took over. He knew at that stage whether price was moving up or down and what that strategy was telling us based on what we had formulated together. So that's why I say anybody can do it. We have different levels of education at Serene Education. You can start off with the online Forex Made Easy. You can come and live with us in our home for 2 days and 2 nights on a Live with a Trader. Or you can join the Yearlong Professionals. It's divided up into 4 different phases. The first one is the Forex Made Easy with the Forex Made Easy strategy. Phase 2 is FX Ultimate 4 and FX Ultimate 8. Phase 3, you come and live with us. And Phase 4 is basically done over the entire year, where you have online Skype sessions, training sessions and support sessions throughout the 12-month period. So there's so many different options that we have to offer. So at the end of every webinar, I always offer a discount, a special offer based on what is available. So what am I going to offer you today? None, Zippo, zero, zilch, nothing. So you're probably thinking, well, what is the Feb special offer then? I've decided to take a different plan of action for February only. So you need to take a good think about this. Our research that we did last year, it showed that there are 3 main reasons that would hold a person back from investing in themselves and investing in Forex. The first one was time. They were worried that they didn't have enough time in order to learn and to trade. Fear, they were scared of the idea of trading because everybody classifies it as risky. And of course, the cost. Well, the first thing is time. We managed to get around that because Forex is a 24-hour market. It's not like trading the stock market. There's always an opportunity for you to look at the market and find a potential trade. Fear, well, Serene Education gives you your own personal sat-nav to take that fear out of your trading, which you're going to see in a couple of seconds from Chris. And the cost, well, this is where the Feb special comes into it. What I know and understand from being in the industry for such a long time is that every person has a different budget and doesn't take action because of cost. You know, some people have more, some people have less. Some people are so desperate to get onto a course and get training in order to make a difference for themselves, but they're worried because maybe the cost is too much for them. So what I've done for Feb is Serene Education will tailor-make your training around your budget. What I'm going to do is give you the opportunity to say what your budget might be, and Chris and I will sit down and we will see what we can do, and it is under no promises, but what we can do to find the perfect educational training program for you that suits your budget. This is only going to be offered in February. It's the first time we have ever done this at Serene Education, but for those of you who know us, Chris and I are very passionate about teaching people how to trade. We put a lot of time and effort into it, and the more people that we can help become financially free or make a second income, you know, whatever it might be, that is what's going to make us happy. People might have been waiting for, did I blow my 10K target given to me by my students by overtrading? Well, I will tell you, I did lose some trades after I hit that 10K target. I entered into 4 trades on a Friday, which is not one of the best things that I do. I don't generally trade on Fridays anyway. If I do, it's in the morning. But I entered into 4 trades. 2 were losers and 2 were winners. So what do you think the outcome was? Well, I didn't lose it, and I ended up with £12,034.19 for the month of January. That could have gone horribly wrong on me. You know, those 4 trades that I could have entered could have all been losing trades, and it would have wiped out more than it would have bought me probably lower than the 8,000 that I'd started out with originally. Now, again, everybody has a downfall in trading and something that you've got to work on. I've been trading for a long time now, and I still have to work on a load of things as well. So don't ever be discouraged if something goes wrong. You veer off the path, you make a mistake in your trading plan, and you take a wrong action. You know, lessons are there to be learned. Just try and keep them under wraps at the best of times. And a final note before I hand you over to Chris. I was watching that magician show, Dynamo, and he said something. I was like, oh my goodness, Chris, rewind that. I have to write that down. He said, there really is no such thing as an ordinary person. Every person has the power to be extraordinary, no matter where they come from or what their circumstances are. It's just a matter of belief. Some people think it's impossible to change the future, but in reality, the future is only what you make of it. And that is so true. I want to leave you with that thought whilst I hand you over to Chris. When you get to that fork in the road, it might not be today, it might be tomorrow, or it might be a week or a year from now. Just think, believe in yourself, and take the right route. So thank you for joining me this evening. I hope you've had fun on our Road Rules experience. I'm going to hand you over to Chris now. I will be around if you've got any questions. Please type them into your chat box and I will answer them as we go. So I'll hand you over to Chris. Thank you very much again.
Good evening, everybody. I hope you guys can hear me clearly this evening. Okay, as Nikki mentioned, just a quick look at the markets, and I'm going to show you the FX8. This is the big daddy of them all. We do have smaller programs, level entry programs like the FME, Forex Made Easy online course. Then we have the FX4, which is one step up from the FME, and then the big daddy is going to be the FX8. And the FX8, I've mentioned a number of occasions, and I'll mention it again, is a template which is very much a mechanical approach. Ideally, we want to have a mechanical approach to our trading. You don't want to bring in the likes of emotion. As Nikki mentioned, overtrading, emotionally tied sometimes to trades can get in the way. And ideally, what we want to do as traders, we want to try and distance ourselves from that aspect. So gone are the days when you used to have things like this, for example. I wonder how many people out there are trading something to this degree. Okay, so what Nikki and I have done is we've taken all of these indicators. We found the ones that really, really resonate the best, have done so over the years, since 2007 in fact. We've had to change a couple things since 2007 because the markets are different. And what we've done is we've taken a whole range of indicators that are best suited for the criteria that we see currently on the markets, and we've come up with something that looks like this. Okay, so something from that to that. Okay, so now what we've done is we've now implemented, this is called the FX8, and it's primarily made up of 8 indicators, and they're all right here on the hard right edge. Very visual, impacting. We've got red and blue. Red for selling and blue for positiveness. Not only that, we have an algorithm that's actually combining all 8 indicators, and they're giving us these red and blue arrows dependent on the time frame and the requirements required on those particular time frames. So now, if you're a trader, the last thing you want to do is you want to have multiple trades open all at one time, trying to look at multiple time frames to try and get a entry on a specific lower time frame. This particular template, nice and clean, okay, getting away from this, okay, which there's a lot of analysis on here. And if you are really good at what you're looking at, this is easy. However, this is easy. Okay, a lot easier for somebody who's never traded before, who's fresh to trading currencies or shares, and wants to be able to approach things very mechanically. It's very, very visually impacting. Okay, we can build up a quick picture very, very quickly in a matter of seconds. What price is doing on multiple time frames, therefore giving us a very, very quick indication of where your price is trading. Is there major support and resistance levels that have been broken? And is there a trade there and then? Okay, and that's what we want to do, want to be as a trader. We want to be able to be, to look at the market, engage the market direction very quickly. Know within the first 5 seconds, if need be, what's happening on that time frame or what's happening on that particular pair, and is there something on there that's going to be something that's going to really excite you. And the FX8 was born out of all of that, and it is, as I mentioned to you, quite visually impacting. There are 4 requirements from this particular template. The 4 requirements up front are the arrow, the candlestick, the RMO, and the OSMO. Okay, which is the arrow, the candlestick color, the RMO, and the OSMO. Okay, those are the 4 requirements that you need. They need to be working with each other on that specific time frame that you're likely to trade. Then, straight away, you can actually look at the indicator box on the hard right edge, and you will be able to know long-term trend. Here, straight away, I've got the monthly in front of me, the weekly and the daily. So just by looking at the monthly, I know that the long-term trend on the monthly is negative. If my monthly is negative, therefore I should be looking to trade with long-term negative sentiment in this case. So therefore I'd like to see the weekly and the daily also complementing that. However, you'll notice here on the euro against US dollar on the monthly chart, you'll notice here on the indicator box that even though we have negative sentiment on our long-term time frames, we have a lot of positive sentiment intraday. So why would that happen? Well, if you look at where price is trading right now on the hard right edge, you'll notice that price actually broke a major support and resistance level, but also a moving average, i.e. the institution moving average, which is the 200 period moving average. Here again, looking at a monthly time frame, you can see that price actually was supported, let me put it that way, over a period of time. Here in particular, I think the institution moving average came through even back as far back as 2006, 2007, but each time she got to this level, price actually corrected. Okay, we consolidated and then we saw a bounce. And over the years, those bounces have got shallower and shallower. Near term, what we saw was a break of that institution moving average and a break of that major support and resistance level. However, this time round, we actually saw a genuine break lower. Here we saw price actually trading into those levels. Okay, you can see the candlesticks. Let me just zoom in so you guys can see this clearly. Trading into the institution moving average, however, closing higher. Trading into the moving average and closing higher. On the hard right edge, though, i.e. here going into the end of 2014, in fact, December's month, trading into the institution moving average and the past major support and resistance level, but closing lower. For the first time now in as many years, we saw a very bearish outlook, which has led to what we've seen in the past month, i.e. January, almost a 900 pip drop, okay, which is a hell of a drop. I mean, we haven't seen a drop of that magnitude, I don't think, since 2010, if I'm not mistaken. 2010, 2011, even before that, the actual crash back in 2008. Okay, so a very, very negative indication, and primarily that was made up of a number of factors, fundamental data that was made aware or came about in December. One of them was the quantitative easing program that was more likely to be introduced by the ECB, the European Central Bank, and January we actually had the outcome, and Draghi and the ECB decided to introduce quantitative easing to the tune of 60 billion euros per month until the end of 2016, which equates to about 1.1 trillion euros of printing, okay, to try and stimulate the market. We also, in the same breath, had Greece Greece saying that we're going to actually have a vote, and the outcome in January was that they had a change in government, and subsequently that didn't really please most people out there, and subsequently we saw that negativity playing through this month. However, price has now fallen quite sharply, and it's fallen to a specific point. In fact, that specific point being a major support and resistance level that goes back to the best part of the late 1990s and the start of 2000, 2001. So price is now consolidative at that point, and if we drop down to the weekly time frames, the nice thing about this template as well, you also get a indicator box here which tells you on the time frame that you're looking at if there's a genuine buy or sell. In this case, we're looking at the weekly chart. Here we go, and you can see sell signal on the euro US dollar on the weekly. And if you look at everything, red arrow, red candles, the RMO below, the OSMO below, all looking good. However, you'll notice the OSMO over here, for example, is dark red. And one thing we want to see when we are trading any particular pair, if we are trading in a negative trend in this case, we want to see price making new lows. So therefore, if prices close low on a weekly, therefore we want to see the following week closing lower, i.e. that would mean any days. Okay, so if a weekly closes on a Friday, that means Sunday evening, Monday, Tuesday, Wednesday, Thursday. The following week, we want to see one of those particular days closing lower than the prior week's close to constitute further continuations with long-term trend, in this case to the downside. Okay, so you can see that last week, in fact, we actually saw prices failing to close lower than the prior week. So now we've had 2 weeks of consolidation and no new lows, and prices consolidated. And you can see that the actual indicator bar here, the OSMO, is dark red, telling us there's no genuine selling sentiment as such at the moment. Therefore, we should be in some sort of consolidation. Okay, so this is telling us that we should just stand aside and wait for further liquidity to come back into the market to push prices lower in the direction of long-term trend. Notice the candlesticks are red. Okay, this is part of the algorithm. So even when we're seeing prices pulling back, the candlesticks have remained red. Okay, and if price is in an uptrend, you can see prices pulling back, but the candlesticks remain blue. Now that's a very, very important part of the actual template, because when you're trading, when you're seeing prices pulling back aggressively, the first thing we do is we have that emotional tie. We go, oh darn. I won't use the word darn. I could use another word, but we start to bring that emotional aspect into our trading, and we start worrying about, was our entry correct? Did we do the right thing? Is my money management in the right place, etc., like that? And what the actual candlestick color does in the algorithm by doing so, giving it a color code, is if you're in a very strong negative or positive trend, you're likely to see consolidation points along that way. That's bound to happen. Okay, that adds to, or that is what trends are all about. There's going to be movements in the market, and there's going to be pullbacks, and those pullbacks are going to be related to fundamentals, or they're going to be related to profit-taking episodes in that particular move. So that's, by having something that's color-coded, even when you're seeing the pullback, is just telling you that the overall bias is still one of negativity or positiveness in this case. Okay, so it just allows you then to feel more at ease, and that's what we want. Okay, here again, it's very mechanical in its approach, and that's what we want ideally from when we look at trades. Okay, so here you can quite clearly see that on the weekly we've seen a pullback. The overall sentiment in the bottom is pretty much correlating on what we're seeing. No new lows would dictate that there's no selling bias or liquidity at the moment there. Therefore, there's more likely to be intraday individuals, traders, investors out there who are looking to purchase something. And if we're trading into major support and resistance level, i.e. selling into a major support and resistance level, you are likely, as Nikki mentioned to have reached a viable target, as Demi and some of our other students have done. They would reach the viable target at this level and start to capitalize from that, i.e. close their positions, take a proportion or percentage of their capital off the table, and you're likely to see those contracts being put back out into the market. And for every seller in the market, there's likely to be a buyer. In this case, when people know that there's going to be a large proportion of trades being closed, your contracts being closed, they will look to enter the market aggressively, counter trend, and just literally take a bit of profit off that bounce. That correction is probably the best word to use. Okay, so that's what we're seeing right now on the euro against US dollar on our smaller time frames. Drop down to the daily, you can see that price today in particular, we saw a nice movement to the upside. Notice the candlesticks are still red. Okay, we have, however, just recently, last week in fact, we actually saw a blue arrow. But if you look at the 4 requirements straight away, we need to see a blue arrow, or an arrow. In this case, it's blue. Okay, great. So it's telling me that there's consolidation or a potential for change in market sentiment. We're negative, change in market sentiment. However, the candlesticks, which is the second requirement of the actual template, need to be the same color as the arrow. They're still red. So I have one positive and one negative. The RMO, okay, we use it for trend direction, is still below the 0 level, which is a negative sign. So now I have one positive, two negative. And then my OSMA, which is the more aggressive one, which is a MACD hybrid version, that's bright green, which is above the 0, which constitutes that it's positive. So now I have two positives and two negatives. Now I need the four requirements to be working together. Straight away, that's telling me that there's no trade because I don't have a confluence where they're all working together as one. Okay, I know the long-term sentiment is down, so therefore I should be looking for a red arrow, red candles, RMO to continue to be red, and the OSMA to turn back to bright red and below to give us a genuine sell indication. So here I don't have any trades. Okay, I shouldn't be taking any trades as such if I'm trading off the daily time frame because there's clearly no confluence between what I'm requiring on my mechanical approach. Okay, long-term sentiment is negative. Okay, if I choose to trade now, I'm now trading counter trend, which means that I'm trading against the long-term bias, which means that my risk goes up 12-fold, and that's not healthy for somebody who's looking to start trading or starting to get into trading as such. Okay, it can be done at a later stage, something we don't really recommend right up front. At a later stage, yes, but then you would have to have the methodology and the requirements, the mechanical requirements, and your risk to be well thought out before you even start trading that types of item. Okay, so that's the euro against US dollar at the moment on the daily. The next one is the sterling against US dollar. Here again, monthly. Straight away I take it to the monthly time frame, and you'll notice that I get a sell signal on the monthly. So I go, great, what do I need to see on the monthly? Look over here, straight on the hard right edge, I can see straight away long-term sentiment is negative, i.e. long-term trend is negative, and the R squared is complementing that. And you can quite clearly see that for the best part of 1, 2, 3, 4, 5, 6, 7 months of selling, very negative, aggressive selling, which has been the case. So therefore, I want to be trading with long-term trend, which is down. I don't want to be trading against it. You can see here again, the intraday sentiment is up, but you can see where price is trading right now as we stand. It is trading at a major area of consolidation in the past. Okay, and people who had actually sold way up here would be well aware that this would have been a potential long-term target, and we're at this level right now, so therefore we're likely to see consolidation because people are going to start closing their accounts, more indecision comes into the market because people are more hesitant to taking trades around major support and resistance levels, which is clearly where we are right now. But we also have a very major news announcement this week, which is non-farm payroll. The start of every new month is the first Friday of every new month. We have very, very important data that comes out for the US market, and not only that, but we tend to see a lot of interest rates announcements for a number of currencies or countries globally as well before non-farm payroll. So primarily from Wednesday, i.e. tomorrow onwards, we tend to see a lot of data that comes out, fundamental data, which leads to a lot of speculative movement, which means there's a lot of volatility, and a lot of it's going to be speculative. They're trying to decipher what the news announcement is going to be, and we don't want to be trading that as such if we don't understand what really is that's happening out there. Okay, so expect a lot of volatility this week, primarily because of we're trading in the start of a new month. Okay, so now as it stands on sterling as US dollar, you can quite clearly see the long-term sentiment is down. I can see that straight away. It didn't take me more than 3 seconds to understand that. Understand, looking right away, where price is trading right now in conjunction to any major support and resistance levels. There again, straight at one. So when I see blue, but the long-term trend is down, I know that this is primarily happening, primarily because we're trading at a major support and resistance level. Okay, see how quickly it was for me to look at the chart and to decipher literally within seconds what I'm likely to expect on any shorter term time frame. So if I'm seeing consolidation in a long-term trend which is negative, and I see a major support and resistance level, that tells me that there's going to be a lot more speculation on those smaller time frames, the hourly, the weekly, especially the daily, the 4-hour, etc. Therefore, I'm going to see prices more consolidative on those time frames, more hesitation, less confirmation between buyers and sellers, which leads to prices ranging. And we don't want to trade ranges, we want to trade trends. Okay, so when I drop down to the weekly, here again I get another sell on my weekly. Look at the weekly charter. Yeah, everything's selling, and the R squared is complementing that selling, so it's telling me it's genuine. However, you can see that the last 2 weeks prior to this week, you'll notice that we failed to make any new lows, and that's what we want to see because we're in a negative trend. I want to see a new low. Why did last week's low or candle fail to close lower than the prior week, which was a bearish candle? Because we're trading into an area of consolidation. Okay, so there again, ideally want to get out of this area, out of this consolidation, and then trade below that. Okay, that's what we want to do. And if I know where my other price support and resistance levels are, if I go back to my monthly now, I can see that there's another major support and resistance level below, and I can really straight away work out roughly what my potential target is. 512 pips, thereabouts, over 500. I'll go with 500. I'll be happy with 450. There's loads on the table to make a genuine return on your time invested. So when I drop down to my weekly, I'm saying, okay, great, get out of this consolidative range, get below this box. And my students are probably giggling now, and then I'll be trading positive, negative sentiment. Okay, at the moment now, trading into it, you're likely to see consolidation because of that fact. Look at the arrow, red. Candlesticks are still red. Okay, my RMO is still below the zero level. The OSMA is clearly below, but it's converging. Okay, that's going to happen. The convergence as we head into major support and resistance lines. Notice, however, I need to see price getting out of this consolidative range, which is clearly what she's in at the moment. And are we going to get some sort of data this week that's going to push price lower, i.e. push sterling lower? Is it going to be fantastic non-farm payroll figures? Is it going to be weak data for sterling? That remains to be seen. However, we want the market to clearly indicate what our next move is, and then we will act on that. Okay, so moving on to the US dollar Swiss franc. Here again, I'm just going to move to the monthly. You can see the fall that the US dollar Swiss franc has had. We saw intervention here back in 2011. Nobody really was interested in that because they didn't want to actually buy a weak euro. And you could see that price actually failed to really move higher over a number of years. And if I just zoom in, you can see intervention here in 2011. We had a nice morning star formation. Prices moved higher, but then we're capped by the major support and resistance line. Now I'm doing all this on the monthly, guys. Ideally, that's where you want to start. You want to get a clear picture of what you're trading. Look at the long-term bias. Look at the long-term trend, and you'll be surprised how the trend and having a major look at price action on the bigger time frames will dictate what's likely to happen going forward. We saw right here on the hard right edge, leading into going into January, in fact, before we saw the Swiss National Bank deciding to come out with its unpegging of its currency against the euro, which led to this massive fall, which a lot of people got caught in. And if you look at what happened on that particular day, let me tell you, we saw a huge drop. In fact, that huge drop took away the best part of 3 years of consolidation, guys. Literally. However, you can quite clearly see near term, we've seen prices moving back, and there's a valid reason for that, because the drop was so drastic that it actually gapped lower. Now, what happens is 90% of the time, gaps are filled in. Okay, and you can quite clearly see that price is now on a 4-hour time frame, moving its way back to fill this gap. Okay, but you can see clearly what actually occurred on that particular day. Okay, the drastic measure. You'll notice that the bias going into that particular announcement was all up. But I want to bring something that's very, very important to this. If you're looking at the daily charts and you're looking for any buying opportunities, you'll notice that leading into that news announcement, we were we noticed, we should have been aware that we had almost a full week of no new highs. Okay, price failed to make any new highs for almost a week leading up to the Swiss National Bank's news announcement. So ideally what we would have liked is saying, well, everything's looking fantastic. If you're looking to trade here, ideally we wanted to see price making a new high, okay, and then we would trade it to the upside. But because price failed to make new highs for a week, we should have been aware that there was less liquidity, there was no liquidity in the markets, therefore there was no potential trades leading up into that news announcement. I'm not saying it would have stopped a lot of people getting unstuck, but it should have started to give a number of bells, warning signals. Okay, I'm just going to stop with the US dollar Japanese yen, which is the last pair of the day. There again, if you look at the US dollar, you'll notice that the US dollar has been on a very aggressive uptrend, very strong bull market for the US market, primarily coming off a lot of quantitative easing, which has led to a lot of positive data, production, manufacturing, lower unemployment figures, high employment figures, which has really moved the market up since those lows in 2011, in fact. However, here again, December gave us a signal, an indecision candle, a lot of bullish bias. You'll see here the indicator box, the long-term trend is still one of up, but you can start seeing a lot of negativity coming through, especially on the weekly and the daily. But December's candle was telling us something, okay? Very, very positive through November, October, September, October, November. Okay, September, October, November, very positive. But we're trading if you're trading through those periods over there, you would have looked at prior areas for target levels. And this particular level here, back in 2005, 2006, before we saw the markets tank, that would have been, you'll notice it's a major consolidation area. Therefore, anybody who's looking to buy here would have looked at this area around here as a potential area to take profit, because we've seen a lot of consolidation around this area. Okay, the more I pan out, you can see the more defined that area becomes. So therefore, as we headed into December, not only we don't get a lot of liquidity in December because the markets potentially from the latter part, from the 20th onwards, people are away, a lot more people are away, and it's festive season, so the markets tend to quieten down a lot going into December. But we saw an indecision candle forming, okay, a spinning top. It still closed higher than the prior month, which still told us that the overall bias was up. However, an indecision candle. Now clearly that was telling us, heads up, the bias is still positive, but we could expect some sort of consolidation going into January. And sure enough, look what happened in January, guys. We saw hesitation in the market. Prices still failed to break the December high, and she's failed to break the December low. Oops, wrong one again. Okay, so what we're seeing now is the US dollar Japanese yen sitting in with, trading within a consolidative range. Okay, and if I drop down to the weekly, you can see what price is done on the weekly. So very positive going into November, then December, first week of December, second week of December, third week of December, and the end of December, not doing anything. Okay, consolidative. And look what's happened over the past couple of weeks. It's still dropping lower, but there's still a hell of a lot of indecision in those candles. Okay, so the US dollar Japanese yen is not a pair that I'm actually be trading at the moment now, primarily because price is just not doing anything. And if I look further back, what happened to the start of last year, in fact, it actually did nothing for the best part of the first 6 or 7 months. And then we saw movement. So, as Nikki mentioned, got to be very, very patient. Price, pairs can be like that. Unfortunately, it is the market. But you'll notice, guys, this is very nice. This is a good example. Notice, within that consolidation, price failed to make new lows. But what was the candlestick color? They were still blue. Okay, still indicating to me, and still will indicate to you, that there's still bias to the upside. Okay, we had a red arrow. The 4 requirements are arrow, candlestick, OSMA, the RMO and OSMA. Here I have a red arrow. Great, that's one negative. Candlesticks, however, are blue, so that's one positive. The RMO is still above the 0, so that is positive. So I have 1 negative, 2 positives. The Osama is below. So now I have 2 negatives, 2 positives. It cancels each other out. The overall trend up until that point was up. So therefore, I should still be looking for bias to the upside. Only when that candlestick turns red and I see a break of the major support and resistance level would I have gone, hang on, I'm seeing a major change in market sentiment long term, which could indicate that we could see further selling opportunities coming into play. Okay, so the beauty of the template, guys, tells you even when you're seeing areas of consolidation where the bias still lies. Okay, and that will allow you to then feel more confident in placing the trades. We know it's just literally consolidation, and you're likely to see those consolidation or profit taking levels within very strong positive or negative trends. Okay, so as it stands at the moment now, the US dollar Japanese yen is ranging. If I drop down to the daily, look at it. It's shocking. It's horrible. You don't want to be trading that. It's not worth it, because all you're doing is you're risking your accounts. You're not getting any true momentum. You're not seeing any true direction. Therefore, you're holding something for a period of time and you're not making any money. That's not good business practice. Okay, so now we just got to wait patiently, wait for that liquidity to either come back into the market to the upside, because I'm still looking for bias to the upside. If she fails to find the liquidity and we fail to see price making new highs, eventually what happens is price is going to break the support level and then the candlestick will change. And if the candlestick changes, then I'm starting to think, oh, hold on a moment, we're likely to see a further pullback because we have a red arrow. The candlesticks are still blue. Okay, but notice how the RMO is almost flat and the Osama is red. Okay, so while it's still trading and not making any new lows, okay, we're still looking for that bias to the upside. Okay, so got to see price breaking below these levels here, i.e. the level of support that we saw back in, what was that, the 16th of January, before we can even contemplate looking for further selling sentiment here. And we would need to see the four requirements in play with each other. Arrow, candlestick, the RMO, and the Osama working together clearly to give us that signal. Okay, guys, I'm going to leave you with that. I hope you guys found it interesting. The benefit of this particular template, as I mentioned to you before, is to bring more of a mechanical approach to trading. It's far better suited. Try and get away from the emotional tie of trading. Have some sort of tick formation, check chart, check a spreadsheet. It's far better because you're distancing yourself that emotional tie to your trading, and it just makes for better trading, to be honest with you. Okay, I don't know if Nick's want to add anything more, but thank you so much for spending some time with us this evening, and I hope you found it a benefit.
Nope, that's it from us, guys. Thank you very much for joining us. What I will do is stay online for the next 5 minutes if anyone's got any questions. And just remember, if you know anybody who knows how to drive a car, send them on the recording and let them know that there are other opportunities to apply those same principles and make money from them. Thank you very much and goodbye.